and welcome back to our series on trading options. My name is Ryan Victorin, and we are continuing our look at options selling strategies. In this video, we'll be talking about the cash-secured put. We'll explain why you might choose this strategy and walk through a hypothetical example to show the potential profit and loss you might experience on a trade. So let's get into the details. A cash-secured put is another two-part strategy, just like the covered call and the protective put we discuss in other videos. In this case, the first part of the strategy involves setting aside cash to cover the cost of the shares that you may be assigned if the put buyer exercises the option. Because as the seller, you're obligated to assume ownership of the underlying investment at the option strike price. And the second part of the strategy is selling the put, which allows you to collect a premium from the buyer. People who use the cash-secured put strategy typically have their eye on a stock that they think might rise in the long term, but they'd prefer to own it at a lower price if the stock dips a little in the short term. In the meantime, selling the put is a way to earn a little income against the cash they set aside to cover the cost of buying those shares. Effectively, they are neutral or slightly bullish on the underlying asset. As always, we have a hypothetical example to help explain how it works. Imagine you're considering an investment in QRS stock, which is currently trading at $92 a share. You decide to sell a QRS put with a $90 strike price, which earns you a $1 premium. Since options contracts typically cover 100 shares, you need to have $9,000 set aside to cover the potential cost of buying those QRS shares if the buyer of the put exercises the contract and puts their shares to you. So now let's take a look at what happens if the stock price rises. And once again, we have a chart showing the potential risk and reward to help visualize what's happening. The first line shows the potential profits if you just own shares of QRS stock and it kept rising. The second line shows your potential profit on the QRS put you sold. If the price of QRS keeps rising or stays flat, then the put will expire worthless and you'll keep the $1 premium you took in, for a total of $100 in profit on the contract. But there's one more thing to consider regarding your potential profits. Remember when we said that people often use cash-secured puts when they like a stock but would rather buy it at a lower price? Here's how that works if the stock price falls. Say the stock is below the $90 strike price at or near the expiration date. It's likely that you'll be assigned the put, which means you need to purchase the underlying shares with the money you set aside earlier. Your purchase price will be $90 a share, but since you took in a $1 per share premium, your net purchase price is $89 a share. That's why some investors think of the cash-secured put as a way to get into a stock position at a lower price and to get paid a little bit for doing so. The premium you earn lowers your effective purchase cost. But the trade-off for waiting to buy shares is that you might miss out on some of the benefits of stock ownership, like receiving dividends or missing out on some capital gains. Now, what about the risk side? In any options trade, you always want to know what your maximum loss would be. In this case, you're obligated to buy the shares at $90. And your worst case scenario is the stock falling all the way to zero. That means you could lose $90 a share minus the $1 premium you took in for selling the put, which gives you a maximum theoretical loss of $89 per share, or $8,900. So that's why people who use the cash-secured put are typically neutral or slightly bullish on the underlying investment. And remember, there are a lot of tools to help you choose an option strategy that's right for you. For example, the Option Strategy Builder located on Fidelity.com gives you step-by-step instructions to find the right strategy for your outlook, time frame, and needs. Okay, we're heading into the home stretch of our series on trading options. We've covered some of the most popular buying and selling strategies. So we're ready to look closely at how you place and monitor your options trades. We'll be covering those topics in future videos, but in the meantime, please drop any questions in the comments section below. And thanks for watching.